Imagine, imagine you're standing in front of a giant heart monitor.
Right, but definitely not for a person.
Exactly. It's for an entire country's economy. And every green spike on that screen is, a rush of adrenaline.
Yeah, a moment of collective optimism. Millions of dollars just flowing straight into the system.
Right. But then every red plunge is this sudden jolt of anxiety. You see capital just fleeing for safety.
Which is pretty terrifying if you're caught in the middle of it.
It really is. And that is exactly what we are looking at today. So welcome to the deep dive.
Glad to be here.
The date is July 30, 2026. And our mission for you today is to take this massive stack of raw financial data. Specifically, we've got 11 different 4-hour stock charts and some index summaries from the Pakistan Stock Exchange, the PSX.
Right.
And we're going to translate those blinking lights into a gripping narrative about an economy that is basically standing at a very real crossroads.
Yeah, because it is remarkably easy to look at a stock chart and just see, like, a line graph, or maybe a jagged mountain range of data points.
Just noise, basically.
Exactly, just noise. But we aren't just reading numbers today. We're reading human psychology. We're reading mechanical trading algorithms, all mapped out onto a grid.
It's fascinating.
It is.
Yeah.
When you actually understand the mechanics behind the screen, a 4-hour chart stops being pure math. It really starts becoming a story about fear, greed, hesitation, and conviction.
Okay, let's unpack this, because before we zoom in on individual companies to see who is, winning and losing, we absolutely have to look at the scoreboard for the whole market.
The macro view.
Exactly, the macro view.
Yeah.
And in Pakistan, that benchmark scoreboard is the KSE 100 index.
Right. So the KSE 100, it tracks the top companies across all these various sectors. It essentially acts as the ultimate barometer for the general mood of the room.
The vibe check for the economy.
Yeah, exactly. The vibe check. And to really read that mood, we need to understand what a 4-hour chart actually is.
Right, because we're not just looking at a squiggly line, we're looking at candlesticks.
Yes, candlesticks. So every single visual marker, every candle on these charts represents exactly 4 hours of trading. The top and bottom of that candle.
A little wicks, right?
Yeah, the wicks. They show the absolute highest and lowest prices during that exact window. And the thick part of the candle shows where the price opened and closed.
So each candle is basically a 4-hour tug-of-war between buyers pulling the price up and sellers dragging it down.
That is the perfect way to look at it.
And looking at the data for July 30, 2026, the buyers are losing their grip.
They really are.
The KSE 100 is currently sitting at 175,547.988. It's down today by 495 points.
Which is a drop of about 0.28%.
Right. And, in a vacuum, that's a paper cut. But when you zoom out, the 52-week range is just this massive chasm. Over the last year, the index had a low of roughly 137,600.
And a high of over 191,000.
Which is insane.
It is immense volatility. We are looking at a market that experienced a massive influx of capital. It pushed it to these historic euphoric heights.
Followed by a serious sustained bout of gravity.
Yeah. Gravity always wins eventually.
And that brings up the defining contradiction in our sources today. If you look at the one-year change, the market is up an incredible 26.83%.
A booming year by any standard.
Totally. But if you look at the year-to-date change, meaning from January 1st to today, July 30th, the market is up exactly 0.86%.
Virtually flat.
It's nothing. And the 4-hour chart for the KSE 100 shows this steep, painful recent drop from a peak near 188,000 all the way down to where we are now, in the mid-175s.
It's a harsh reality check.
Right. I look at this and I picture like a marathon runner who sprinted the first 20 miles. They put up a 26% gain. They passed everyone, felt completely invincible.
Oh, I see where you're going with this.
But looking at that flat year-to-date number and this current steep drop on the 4-hour chart, they've completely hit a wall. So is this just a runner catching their breath on the side of the road, or is this a runner collapsing?
Well, if we connect this to the bigger picture, markets actually have to mechanically digest their massive gains.
Mechanically digest.
Yeah. You physically cannot run a sprint pace for a full marathon. The financial term for catching your breath is consolidation.
Consolidation, okay.
Right. When a market runs up nearly 27% in a trailing 12-month period, you reach a tipping point. Institutional investors, the big banks, the huge funds, they look at their portfolios and they execute profit-taking strategies.
Just cash out.
Exactly. That mechanical selling neutralizes the buyers, so that flat year-to-date number of 0.86%, That just represents a grueling 7-month tug of war.
So it's not necessarily a crash.
Not necessarily, no. If you can picture a wide bird's eye view of a bustling metropolis, right? The traffic hasn't completely stopped, but the gridlock has definitely set in.
I hear you. But I'm not totally buying the healthy consolidation narrative, though.
No.
No. When I look at that 4-hour chart falling out of the sky from 188,000,
Yeah.
that doesn't look like gridlock to me. That looks like a bridge collapsing.
That's a fair point. It is a very sharp drop.
Right. And to understand where the market is going next, we really have to look at what's causing that specific plunge.
What?
Which leads us to the literal foundation of the economy.
The infrastructure and cement sector.
Exactly.
It is impossible, truly impossible, to overstate the importance of cement in an emerging or developing market.
Because it's the ultimate leading indicator of physical growth, right?
Precisely. If you are building dams or highways, commercial real estate, housing, you need poured concrete. Lots of it.
Well, here's where it gets really interesting. Because we pull up the charts for the major cement players. They are just bleeding out.
They really are.
Let's use Lucky Cement, ticker LUCK, as our anchor here.
Yeah.
I mean, they are the titan of the industry. The stock is sitting at 439.48, and its 4-hour chart shows this violent, recent downward plunge.
Yeah, it basically fell off a cliff.
And it's desperately trying to find a floor.
And finding a floor, you have to remember, isn't just about human intuition. It's about algorithmic support levels.
Meaning what, exactly?
Meaning the price drops to a point where automated buying finally outweighs the automated selling. But the downward momentum for Lucky Cement is so fierce right now.
And it's not an isolated incident.
Not at all. The entire sector is flashing red.
We see the exact same thing echoing across the board. Maple Leaf Cement, ticker MLCF, is sitting at 95.70, and DG Con Cement, DGKC, is at 207.20.
Both of which are showing massive breakdown patterns.
Yeah, with incredibly high volatility. Maple Leaf's chart is particularly alarming to me. It had this tidy upward channel, parallel lines, where the stock was predictably bouncing up and down, making higher highs.
It's very comfortable.
Yeah, until recently, when it just crashed straight through the bottom line of that channel.
See, this is where we have to separate emotional panic from mechanical selling. A breakdown like we are seeing in Maple Leaf and DG Con is a major structural event.
Because an upward channel is basically market consensus, right?
Exactly. Everyone basically agrees the company is gaining value. That bottom line of the channel acts as a safety net. But when the price breaches that net, it isn't just humans deciding to sell in a panic.
Oh, I see.
It actually triggers automated stop loss orders.
Okay, wait. Explain that mechanism for a second.
Yeah.
What is a stop loss doing in this specific scenario?
So institutional traders use software to protect their investments. They literally program their computers to say, hey, if the price drops below the specific channel, sell my shares immediately before I lose more money.
Wow. So it's totally emotionless.
Completely. So when Maple Leaf cracked that bottom line, it triggered a cascade of mechanical algorithmic selling. The volume spikes, the price plummets.
And that automated dumping is exactly what's dragging the KSE 100 index down right now.
Yes. If you close your eyes, you shouldn't just picture lines on a screen. You should picture a structural blueprint of a skyscraper literally catching fire.
But why is the consensus shattering in the first place? I mean, poured concrete and building projects represent tangible physical capital. That should be safe.
Right. Well, being physical is exactly the vulnerability here. Heavy industry is hypersensitive to interest rates and inflation.
Oh, right. The borrowing costs.
Exactly. If it costs too much to borrow money, massive infrastructure projects just get paused. Commercial real estate slows down.
Investors look at the blueprints of the economy and decide the cost of construction is just too high to fund.
Bingo.
And that perfectly bridges us from the materials that build the economy to the fuel and the vehicles that actually move it.
The energy and automotive sectors.
Right. Because if the buildings aren't going up, the supply chains must be freezing. Let's check the charts for Pakistan State Oil, ticker PSO. The price is at 337.24.
And just like the cement stocks, PSO has dropped sharply out of an established upward channel.
Yeah, and its RSI is hovering down near 38.88.
RSI, the relative strength index. We need to be really clear about how this actually functions.
Yeah, I mean, I know it measures the speed and change of price movements, right? On a scale from 0 to 100.
That's the basic definition, yeah.
And usually anything under 30 is considered oversold, and anything over 70 is overbought. So PSO being at 38.88 means it's tumbling fast toward that oversold territory.
Right, but RSI isn't just a speedometer for you to look at, it's a tripwire.
A tripwire.
Yeah, when a major stock like PSO approaches that 30 mark, institutional algorithms often just wake up. It's a mathematical signal that an asset is being heavily, heavily dumped.
So the selling pressure on the state's primary oil provider is intense right now.
Very intense.
And if PSO is the fuel, let's look at the wheels. We've got Gondara Automobiles, ticker GAL, trading at 591.07, and this chart is violently erratic.
The volatility is off the charts.
We are talking about massive 4-hour green candles showing explosive, almost desperate buying, followed instantly by massive red candles showing brutal, overriding selling.
Which is culminating in a very sharp drop.
Yeah. And confirming this trend, we have Gondara Tire and Rubber, ticker GTYR, at 32.00. It is trapped in a clear, descending downward channel. Every single time it tries to tick up, it gets mechanically swatted back down.
It's a rough spot to be in.
Truly. If the economy is an engine, it is sputtering hard. PSO is the fuel, GAL and GTYR are the wheels. And looking at these charts, the whole vehicle looks stressed.
What's fascinating here is the systemic friction. This is why reading these charts together is so vital.
Because they tell a connected story.
Exactly.
Right.
We just saw the foundation cement breaking down. Mechanically, if fewer construction projects are happening, you simply do not dispatch as many heavy commercial vehicles.
Which instantly hits Gondar Automobile's forward projections.
Exactly. And if you aren't running those fleets, you aren't wearing out as many tires, which puts mechanical downward pressure on Gondara Tire and Rubber.
Oh, wow. And if commercial fleets are just parked in a lot, aggregate demand for industrial fuel drops, which breaks Pakistan state oil right out of its upward channel.
It is a visual representation of a physical supply chain literally hitting the brakes, all captured in 4-hour intervals.
That is wild. The selling across these sectors is entirely correlated.
Precisely.
But, money doesn't just evaporate. When institutional investors trigger their stop losses and liquidate out of cement, oil, and autos, they have cash sitting in their accounts.
And they rarely just hoard cash during periods of high inflation.
Right, it rotated.
Because capital is like water. It aggressively seeks the path of least resistance and highest yield.
Okay, so if physical infrastructure is breaking down, where is the capital flowing? Let's pull up Pakistan Telecommunication Co., ticker PTC. The price is 71.0.
And what do you see there?
Unlike almost everything else we've looked at today, PTC is actually maintaining a broad, healthy upward channel. The chart looks totally relaxed.
It really does.
It's calmly climbing the stairs while the heavy industries are falling out the window.
This raises an important question about exactly what kind of infrastructure investors value during a physical slowdown.
Well, we also see resilience in Interloop Ltd., ticker ILP, sitting at 102.63.
Yeah.
They are experiencing a recent pullback, like a little dip, but they are safely bouncing around within their established upward trend lines.
Right, the chart hasn't suffered the algorithmic breakdown we saw in cement.
Exactly. And then we have companies like TPO Corp at 19.10 and Gotti Chemical Industries, GCIL, at 37.34. Both of these charts show the stocks essentially moving sideways in a tight range.
This is the phenomenon of sector rotation at work.
Meaning what for the everyday investor?
When the broader market is dropping in the short term, investors play defense. They look at physical heavy industry cement, automotive, state oil, and they see vulnerability to inflation and supply chain friction.
So they pivot.
Right. They rotate into digital infrastructure. Pakistan Telecommunication maintaining an upward channel tells us that investors view connectivity and data as a necessity, not a luxury.
Wait, let me smack you there and push back on TPL and GCIL, though. You are grouping them into this resilient category, but they're each just moving sideways.
Yeah, they are.
Is going sideways really a victory? Or is that just a sign of dead liquidity, like a stock slowly dying of thirst because there's absolutely no buyer interest left to push it up?
It's a fair challenge. But in the context of a market where the heavyweights are plunging violently, sideways movement usually indicates institutional absorption, not dead liquidity.
Institutional absorption. So they are quietly buying it up.
Exactly. The sellers are trying to push the price down, but buyers are quietly stepping in to match every single sell order at that specific price point. They are basically building a base.
Oh, I see.
And regarding the shift to digital, when you look at the telecom charts, You shouldn't just see lines and numbers. You should be picturing glowing fiber optic networks expanding safely underground.
Completely immune to the supply chain traffic jams happening above ground.
Exactly. You can't put a roadblock on a fiber optic network.
You really cannot.
Yeah.
And Interloop, being in textiles and apparel, often relies heavily on exports, right?
Yes, very heavily.
So a stock maintaining its upward trend line while the domestic market falls suggests investors believe its revenue streams, which are diversified globally, are fundamentally safer than local construction projects.
That is exactly the read.
So what does this all mean for you listening? It means we are witnessing a real-time, massive migration of capital.
A huge shift.
We are watching the big money systematically rotate out of physical, domestic-heavy infrastructure like poured concrete and state oil, and rotate into the insulated resilience of digital networks, telecommunications, and stable export-driven equities.
They are trading the physical highway for the information highway to ride out the storm.
It is a profound shift in market sentiment. The KSE 100 isn't just dropping,
Yeah.
It is fundamentally reweighting what it values in real time.
It is. Which brings us to the 30,000-foot view.
Right. We started by looking at the PSX on this day, July 30, 2026, as a giant heart monitor. And what we found is a market that went on an absolute monster of a one-year run-up nearly 27%.
Incredible gains.
But right now, today, it is taking a deeply painful breather.
The heavy foundational sectors, the ones requiring massive physical capital and momentum, are being aggressively punished by both human hesitation and mechanical stop losses.
Right. Cement and oil are breaking their support lines. The automotive sector is suffering immense volatility.
But simultaneously, telecom and textiles are stubbornly holding the line. They're absorbing the capital fleeing from the industrials.
And this is exactly why you should care about 4-hour stock charts. Even if you don't trade on the Pakistan Stock Exchange.
Even if you've never looked at an RSI indicator in your life.
Exactly. Because these charts aren't just obscure math. This is how you read the real-time anxieties, the immediate hopes, and the tactical capital rotations of an entire nation.
Yes.
When a cement chart crashes, it means somewhere a building isn't getting built. When a telecom chart rises, it means somewhere digital infrastructure is quietly expanding.
It is the pulse of human endeavor, just quantified, color-coded, and mapped out in 4-hour intervals.
You're beautifully said.
Yeah.
And that leaves us with one final, lingering question to ponder as we wrap up this deep dive.
What's that?
Well, we've seen the mechanics of today. We've watched the capital flee the physical world and rush into the digital safe haven of telecommunications.
Right.
But if all that institutional money continues to crowd into sectors like telecom simply because it's a safe place to hide, are they just artificially inflating a massive new tech bubble?
Oh, that's a dangerous thought.
Right. Or, conversely, if the algorithmic selling in cement and oil pushes those foundational companies down to rock-bottom prices, at what point do massive foreign investment funds realize a country's entire physical infrastructure is essentially on sale for pennies on the dollar?
And swoop in to buy it all up.
Exactly. The charts tell us what's happening right now, but the unintended consequences of this massive capital rotation, they are just beginning. Something to keep an eye on.